Hey everyone, it's Daniel here from Infovest, keeping you updated on the market news and the economy. I just want to go over and talk about CPI and inflation, right? A lot of talks about inflation, a lot of talks about inflation down the road, where it's going. People saying that, inflation has peaked. You look at the stock market and the equity market, it's been rallying quite a bit since the lows of June. And after the CPI report that we got recently in August, basically showed that due to gasoline prices coming down, the number of headline year over year number came in about 8.5% versus the expected of 8.7. When prior to that number, we got 9.1% in terms of inflation headline CPI year over year. So, from that one report, you're getting a lot of traders and a lot of people, and the sentiment has basically gone to a very positive sentiment where people are pricing in that inflation has peaked. It's going to come down now as long as gasoline and other energy prices and commodities continue to fall. You'll probably see inflation continue to fall as well. And a lot of people see that down the road, 6 months from now and a year from now, yes, inflation will reach slowly and get close to that 2% level. Now, can inflation go negative? Can the CPI report go negative? Can you get a negative inflation rate? And can it happen drastically and very fast? Sure, it's very possible. And what scenario would a negative inflation rate come in? When would that come? How would that look like? What would the economy look like in that scenario? And what would drive it, most importantly, to that scenario? Now, a negative inflation rate, basically, when you look at the past data of inflation, the past 10, 20 years, and I'll try to put a link below in the description. When you look at the past 10, 20 years of data and you see that inflation rate has been fluctuating around 2%, and the time we go below 2%, and the time we even touch zero or even below that, usually is a time when we are in some sort of massive recession. So if, let's say, a lot of people are predicting, a lot of people are saying that, the recession is going to be mild. It's not going to be as bad as what people are thinking. Some people are saying that the recession is canceled. I say it's too early, too premature to be calling that. But if the expectation is that the jobs data and the growth data due to higher rates is expected to kind of contract maybe 6 months from now, but by next year, the growth data and the employment data is expected to contract. And if we end up in a very ugly, severe recession in next year, then definitely that inflation, that CPI, is going to drop heavily. And would it take a recession to really take us below that 2% level? Now, the Fed is looking to, meet the inflation rate around 2%. That's their target. And they may also keep rates elevated for some time to bring inflation to that level. But if you get a severe recession and you get a massive crash in the markets, definitely you could see inflation come off not only to 2%, but way below that, may even go negative. So yes, we could see a negative inflation rate, especially after a massive, massive recession, a severe one. And you've seen that in the past. Again, I'll put a link in the description, but you've seen that in the past with previous recessions, with previous data, with previous CPI reports, where it has gone below 2%. So hitting 2% and being around the 2% level or being at 2% is almost difficult, impossible to do. We'll either be above 2% or we'll be quite below 2%, and we may hit 2% at times, we may go above it sometimes, but we will most of the time be around 2%. And if it really takes a severe recession to kick in to bring that inflation rate and that CPI down to below 2%, then hey, that's where inflation could really correct itself, especially if the Fed is not going to be as aggressive as certain traders and market participants are expecting, that the Fed may not continue to raise rates as aggressive and at the current pace, and they may actually start cutting rates next year. And if they're cutting rates, why would they be cutting rates? Right? Why would they be cutting rates next year? What would be the reason to do that? It's to create easing in the financial system, in the economy, in the markets. But if the jobs are doing well and employment is doing well and inflation is still high, why cut rates? Right? What is the market's trying to price in? And probably it might be pricing in is trying to figure out that, okay, the Fed continues on this rate course path, then by next year we're going to get very weak growth jobs data, which is probably then going to lead to this recession, and not a mild recession, probably a severe recession, which then follows by a rate cut, right? So, I would say watch the bonds, watch how the bond markets are reacting. The bond market will start to react first, especially if there's signs of recession and something is looking like it's going to break. Watch the long end, the 30-year bond. You'll start seeing the 30-year bond start ripping, especially if there's signs of the markets are now breaking, or something in the economy is breaking. And you can see that from looking at the bonds and the yield curve, right? So leave a comment below. Let me know what you guys think. Are we going to see inflation hit 2% below? Are we going to see negative inflation rate? Let me know what you guys think. Subscribe, like this video, and I'll see you guys around. Thanks. Bye.